The risk of loss in trading futures and options can be substantial. Therefore, only genuine risk funds should be used in such trading. Futures and options may not be a suitable investment for all individuals, and individuals should carefully consider their financial condition in deciding whether to trade. Option traders should be aware that the exercise of a long option will result in a futures position. Information herein has been obtained and prepared from sources believed to be reliable. Comments contained in these materials are not intended to be solicitation to buy or sell any of the commodities mentioned. Past performance is not indicative of any future performance. Opinions expressed here are the opinions of the author only, and not the opinion of any firm the author may be affiliated or associated with.
Welcome back to Commodity Classics. I'm Michael Yorba, your host. My guest this segment is John Netto, and let's bring him in right now. John, how you doing?
Michael, second baby.
Okay. All right. Well, let's see what's. I should have asked you who was going to win the Indy 500. Okay, but did you see that race? That was a I thought Danica Patrick was going to go over there and just knock somebody's teeth out.
You know, she'd have been right too. She was totally in the right. She took the high lane when she was trying to pass by, and unfortunately, her back suspension got clipped and busted her out. It's an unfortunate part of racing, and really the Andretti family that sponsors her was rightfully upset along with Danica as well. I want to say Danica, I think, was getting 9 or 10 to 1 here in Vegas to win the Indy. She didn't come through though, and we'll just take it from there.
Okay. All right. So what do you got to tell us? What are your wise words of wisdom about trading now?
I think what you want to look for this week, anyways, is more about taking it easy as far as the volume goes. We saw run rates for most of today, even though the market was rallying. We're looking at run rates that were near 30% below the 6-month volume.
Right.
Obviously over the last 6 months, and when the market gets like that, it's very easy for one buy program or one sell program to significantly influence how everything is set up. So that's the process with that.
Okay. So are you doing any trading? Are you buying or selling anything? Is just sitting there, got some spreads going? You're just picking up premium? What's going on?
A whole lot of stuff. It's one of those deals where I honestly think that this is a week that you want to be very careful. This is a time when a lot of people are going on vacation. A lot of graduations around the country are happening. Again, we're seeing lower volume. I am still active in the crude market because it doesn't really stop for anything, outside the second coming. And so I think that the crude itself is probably the crude of the energy complex is really the only market you want to trade. We did see today, and I'm going to show on the chart here the daily chart on gold. We see gold pulling back here to the 900 level. I think that if you want to take on a space, and we mentioned this last week on the show, that gold would attempt to, it's rallying now, but it would attempt to make a pullback, and from there we're going to see overall what happens.
Right, because you were saying that you really feel that the low has been made in the gold market.
Right, the low has been made in the gold market. We've got a nice pullback in there today. I think that tomorrow we'll see some further weakness. It wouldn't surprise me if gold hit $8.95 an ounce on the June contract, but something for people to keep in mind is that this June contract actually goes into delivery risk at the end of this week. So you want to be very careful that you don't get long a contract, and the next thing you know, the position's delivered against you.
Right.
I would tell people, if you're going to trade gold, go ahead and trade the August contract, and it's a much better circumstance situation to work off of.
All right, what's your thought? You mentioned oil. Are you looking for oil's volatility to increase, for it to give us a rounding top? Because some people are saying it's over, it's topped, it's going to create a vacuum, and some people are saying, hey, there's too many fundamentals driving the demand side of this market. So
I think that the real answer comes into charting the money flow of these commodity pools.
Okay.
You can keep track of how they're allocating. Many of them are entering these markets irrespective of price, and as long as they're not being hit by redemptions, you're going to see this general secular trend continue. I do think, though, based on the price action I saw today, that crude has a real strong potential of selling down to the 125 level even as soon as tomorrow or maybe by Thursday morning. We have the inventories number coming out tomorrow. Let me put up a chart of crude here.
Yeah.
Kind of show you guys what spot I'm looking at to again, here at Yorba TV, we want to provide value for the listeners. And here's a key inflection point that we are. If you could scroll to the right ever so slightly on my screen.
I guess nobody's paying attention in the control room.
I talk fast. It's all my fault.
You did what?
I said, but at any rate, if you look, if we can somehow scroll to the right on.
Okay.
There we go. I'll adjust it on my end, Mike. There we go.
All right, there we go.
So what you see here is crude is pulled back, but we have a nice 618 retracement here, and we have a nice, longer term 382 retracement right here at the 125 level. All right, so this area right in here, where I'm showing right near this 15 MA, right near this Fibonacci support area, is a spot that we could sell down to tomorrow and get a really nice reaction off of. So even though it's a holiday, crude's giving us a little bit of movement. I would temper my enthusiasm as far as trading the equity markets, though, and keep an eye on the yield curve right now. We saw a nice sell-off across the yield curve, actually rally in the yield curve today, but a sell-off in the bonds today. Everything from the euro dollars, 2s, 5s, 10s, and 30s all came in and got hit pretty good. So it's something that I'm just very circumspect during this week as far as getting too aggressive with anything outside of the energy complex. Crude is such a polarizing trading market right now. It really has a lot of people divided on both sides, and that's a good market to be involved in as a trader. As far as the equity markets go, I mean, I'll punch up the S&P chart right now, and you'll see that,
Well, let me get this straight. Your target there for crude is 125.
125, 125.50 tomorrow.
Okay.
If we get a sell down early tomorrow morning, I expect the short term. I expect the shorts that have been short this thing to come in and begin to cover their positions, and I expect some institutional buttressing to take place that will drive crude back maybe to the 130, 132 level by the end of the week if we actually hit the 125 level there. So that's what I'm looking at.
Okay. All right. Now you're going to bring up some equity charts and give us something. What are we looking at here? Is that?
Yeah, the Russell. This is the S&P 500.
All right.
And this S&P 500. I just wanted to demonstrate just the inability of this market to break outside of a meaningful range. We can go back here to the early part of May. We can go to the middle of April. We can even go to the beginning of April, and you can see that over a 2-month time period, even going back 2 months, that we more or less at the same spot we were 2 months ago. There's been, yes, one substantive sell down. We've tried to rally a few times, but overall we've seen a lot of compressed candles. We've seen just a market that isn't giving us so much in the way of real trading opportunity. Now everyone can come in and say, oh, I should have got short of the highs. Look, I could have played this move here and whatnot, but honestly, there's just not much happening in this overall range, and there's other markets that have lower hanging fruit that I'd recommend people focus on.
Okay. I've got a quick question on the shout box for you.
Hey, fire.
Do you use gaps for trading, and if yes, how effective do you feel they are?
I use major gaps. Thank you for the question. I do use gaps when they correspond to a major technical support or technical resistance level. If the market is in a strong uptrend and it gaps down after being in a strong uptrend, then I'll sit back and look to buy that, buy the dip or buy the gap along that line. As far as if it comes to major support, meaning so we rally 5 days in a row, we gap down the next day. I'm probably more inclined to fade that gap by going long, as opposed to if we, and again, it's all circumstance, but if we sell down and then we, sell down again, my policy is to buy weakness in rising markets and sell strength in the falling markets. But with the way that crude works and the way that gold works, these markets trade 22, 23 hours a day, and they follow their overseas markets as well. You have the London Metals Exchange, we have the Tokyo Commodities Exchange, where these markets can move and trade as well. So we have the Dubai, the Dubai Exchange as well, where you can trade these commodities. So there's a worldwide flow that goes on, and the gap dynamic of a market is no longer what it used to be. Because even though the S&P may be down, the Dow Jones Euro Stocks, the DAX, the FTSE, all those markets that trade in Europe were trading throughout the overnight session. So there was a chance for the market to establish a rhythm and a flow to it.
Okay, here's a question from me. Are you watching? I know that you've got this hedge fund that you're trading. It's trading the metals for. Are you keeping an eye on what's going on with the U.S. dollar, the euro, and some of these other foreign currencies?
If you're trading metals, you have to keep an eye on what's going on with the U.S. dollar. It's a critical component of understanding the entire commodities and energies complex. Wheat, grain, soft, hards, OJ, cotton, you name it, whatever you want to throw in that basket of commodities, many of them have a direct correlation to a strengthening or weakening U.S. dollar. And so you need to be extremely cognizant of major technical support points and the overall strength of the USD. And it still goes part and parcel with the overall supply and demand dynamic that's happening around the world right now, which is another key driver behind this commodities boom. So, yes, we still keep track of the fundamentals. Yes, we keep track of the price action of the respective commodity we're trading. But having a keen awareness and being particularly acute to what the U.S. dollar is doing plays a big role in our overall investment strategy and in our investment execution.
So your opinion of the U.S. dollar right now?
Bearish, neutral. Yeah, I mean, we talked about this last week, and I think that, you know, we have the Euro USD, and again, you ask about the USD, Michael, so, and I have to respond obligatorily, well, which cross are you referring to? Because depending, you know, the Euro USD cross carries with a different dynamics than the Euro, than the Aussie USD or the USD Mexican peso. Right. Or the Brazilian Real USD. There's different, you know, negative carry, positive carry, respective economies, trade-weighted U.S. dollar versus the dollar that's traded on the New York Board of Trade, the NIBOT U.S. dollar. Overall, though, I think we're looking at a bearish sort of neutral tone to the U.S. dollar on a global dollar index level, if you will. Okay.
Now, I've got a question. Obviously, this is from one of our European viewers. The English is a little different, so I'm going to work to interpret it for you. It says, how you like two gaps on the HIS around 21,000 and 23,000. That's a Hong Kong index. Are you watching that one?
I don't know the symbol for that chart, so I can't comment, Mike. Sorry.
Okay. All right. No problem. All right. So you're neutral to bearish on the U.S. dollar. And do you have any support levels that you'd like to see broken for the further downside of the U.S. dollar?
Well, I think that there's a longer term buy point on the Euro USD cross, meaning, like, if you want to look at the index at 150, we got down as low as 152.50 between the Euro USD. I thought we'd go to 150 for a longer term major buy on a weekly. That didn't unfold as I thought it would. We now have bounced back up to near the 157 level again. 156.88 is where the spot market is right now. Right. And I think that, you know, 1.6 is going to serve as a cap on this thing, and then again come in the fall when, see, the biggest thing holding back the dollar from selling off right now is people think that the Fed is done raising rate or is done cutting rates, and so there's a concern with they're done cutting rates. That only kind of leaves one action left, and that leaves them, you know, room to go back and start maybe more of a hawkish tone again. And I think that a lot of people who have, you know, come in and covered some of their dollar shorts, when it becomes pretty clear that the Fed is not going to be raising rates at the end of this year again, I think the dollar maybe go through another down leg, and that's where I think we see the euro break through the 160 level against the USD. I think that's where we see the Aussie, you know, rally to parity. I think it's where we see a number of major crosses put in multi-30, 40-year highs against the greenback.
Good, good. All right, we're at the end of our segment. John, thanks so much, buddy.
Always a pleasure, Michael. Thanks for having me.
We'll talk to you later. All right, that was John Netto. He is the Chief Investment Officer of Triple Witch Metals Management, and he's been a really, really nice addition to our network. All right, we'll be right back, and I'm going to talk to you about something that I've come up with myself. Michael Yorba here on Commodity Classics. Sit tight. We'll be right back for something just from me on our network. We'll talk to you then.